Have you ever pondered the mysterious disappearance of your socks after tossing them into the dryer, never to be seen again? It's a perplexing enigma that may forever remain unsolved. Similarly, many individuals experience a sense of bewilderment when they discover that their investment account balance has plummeted. Where did that money vanish to? Fear not, for money lost in the stock market doesn't simply evaporate into thin air. Let's delve into what actually occurs. Vanishing funds. Before exploring the vanishing act of money, it's crucial to grasp that whether the market is on an upswing, bull market, or a downturn, bear market, stock prices are primarily driven by supply and demand. It's the fluctuations in these prices, along with the timing of buying and selling shares, that dictate whether one gains or loses money. Buy and sell transaction. If you buy a stock at $20 and later sell it for $15, you incur a loss of $5 per share. While it might seem like that money goes directly to someone else, the reality is a bit more nuanced. It doesn't necessarily go to the person who buys the stock from you. For instance, imagine you intended to purchase a stock at $25 per share, but before you do, its price dips to $20. Opting to buy at $20 doesn't mean you've gained the $5 drop in price. Instead, you acquire the stock at the prevailing market rate of $20 per share. You might think you've saved $5, but in actuality, you haven't made a profit. However, if the stock subsequently rebounds from $20 to $25, you'll realize a $5 gain. The same principle applies when selling a stock at a loss. The individual purchasing it at the reduced price, your selling price, doesn't necessarily profit from your loss. Their entry point is the lower price, and they must wait for the stock to surpass that level to make a profit. Neither the company issuing the stock nor any specific investor pockets the money from your loss. Changes in stock prices aren't tabulated and distributed to investors. They're merely reflections of supply and demand dynamics and corresponding trading activities. Short selling. Some investors engage in short selling, wherein they sell a stock they don't own, expecting its price to decline. Let's say investor A believes that company XYZ's stock, currently priced at $50 per share, will decrease in value. They borrow 100 shares of company XYZ from their broker and immediately sell them in the market, generating $5,000, $50 x $100 shares, in proceeds. If the stock price indeed falls to $40 per share, investor A can buy back the 100 shares at this lower price, costing them $4,000. They then return these shares to their broker. The net difference between the proceeds from the initial sale and the cost of repurchasing the shares is $1,000, $5,000, $4,000, which constitutes investor A's profit from the short sale. However, if the stock price rises instead, say to $60 per share, investor A faces a loss. Buying back the 100 shares at this higher price would cost them $6,000, resulting in a loss of $1,000, $6,000, $5,000 on the short sale. Whether short selling results in a profit or loss depends on the subsequent movement of the stock price, and short sellers assume the risk of potential losses, just like investors who buy stocks traditionally. The vanishing act unveiled. So, where does the money go? In essence, it evaporates due to a decrease in demand for the stock, triggered by a decline in investors' favorable perceptions or market sentiment. This phenomenon underscores the complex and paradoxical nature of money. Money can simultaneously feel intangible, tantalizing our dreams and desires, yet tangible, serving as the means to our daily sustenance. Implicit and explicit value. Money's duality mirrors a stock's market value, comprising implicit and explicit components. Implicit value hinges on investors' perceptions and research, influenced by factors such as revenue projections and market sentiment. A shift in implicit value, driven by abstract notions like faith and emotion, impacts stock prices, leaving investors with gains or losses. Explicit value, on the other hand, represents a company's concrete worth, calculated by tallying its assets and liabilities. It forms the basis for investors' assessment of a company's financial health and performance. The explicit value anchors the stock's implicit value. As a company's earnings and performance improve, investor confidence grows, bolstering the stock's value. In summary, while the stock market can be a vehicle for wealth creation or depletion, the disappearance of money mirrors the ebb and flow of investor perception and market dynamics.